Core PCE, that Fed's preferred inflation gauge, as Jen said, coming in below 3% for the first time in nearly 3 years. This comes with the Federal Reserve's first meeting of the year coming on Wednesday of next week. Joining me now is Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Megan, let me get your take on the number we got today. Does this change your outlook on the Fed's trajectory?
No, obviously this is good news. This is what it's actually been expected, that we would continue to decelerate in inflation. We don't think it changes anything as far as our view on what the Federal Reserve can do this year. Our bigger concern is because economic growth has been strong to end last year, the consumer has been strong to end last year, and consumer confidence has ticked up a bit. We are concerned about that reignition, I guess you could say, of inflation and what that would mean for the Fed. We think they'll comment on that they're watching that closely. And we think that's going to keep the Fed on hold for at least the first half of this year.
Did the data we got today point to any of those concerns you just highlighted? What specifically are you watching about a potential reacceleration in those prices?
So most of the data that we've gotten, whether it's retail sales or their personal income and spending, let's remember all of this is fourth quarter of last year. We don't have a ton of information yet until, I guess you could say, next week of January data and what we're going to see in the first quarter of this year. So what we're worried about with inflation is that the consumer just continues to spend. They continue to spend with the anticipation that the Fed's going to come in, cut rates, and save the day. They're spending on credit cards. The credit card debt is accelerating at a rapid pace. That's concerning for us from the economic standpoint. From the inflation standpoint, we're concerned about what's going on in the Red Sea, what that means for shipping costs, what that can do to inflation. And if you look at consumer confidence, if these consumers continue to spend, you could see a lot of volatility in inflation. You could see some monthly data that comes in a bit higher, and that's going to spook the Fed. That's why I think they're just going to err on the side of caution and remain on hold for a while.
Specifically on those shipping costs, with what's playing out in the Red Sea, is this just about how prolonged this is, or are you already starting to see the impact that raises some concerns?
Not yet. You're not going to see it yet. I mean, there's been a lot of different people who are studying this that have mentioned we should start to see maybe February or March higher prices. And you could see an uptick in these inflation as early as the February data, possibly even the January data. It all depends, as you said, on how long this goes on. Let's remember the last time back in 2021 when we had a tanker that upended in the Suez Canal, and that did result in some impacts from that shipping. But that was a short period of time before they got that moving again. There are some economists that are saying that this could last 6 months up to a year. That's problematic, and that's something that the Fed has to keep their eye on.
The next big economic data point we're looking for, jobs numbers out next week, a week from now. We've gotten a number of announcements just this week alone on tech layoffs, and sort of trying to figure out how much of this is just about the overhiring that happened in the tech space. How much of this is a sign of things to come? How have you been looking at those headlines?
Well, it's part of the cracks that we've been seeing emerging in the labor market, not just recently. This has been going on for several months now. We've been seeing these layoff reports, but it's not really filtering into those jobs numbers or the unemployment rate. So that's something that, that I think you're going to see continued layoffs, though, going into next year. I do think there was some overhiring, and I think part of the reason why the unemployment rate has remained so stubbornly low is that employers have been, hesitant to lay off employees as quickly as they probably should have with the economy slowing. And that's because it was hard to get employees in the first place during the pandemic. So they're holding on to them. When it comes to the tech side, I definitely agree. There's been a lot of overhiring in that area.
Megan Horneman, Verdence Capital Advisors Chief Investment Officer. Good to talk to you on this Friday.
Thanks.